All right, today we're going to tackle something called the yield curve. Now, I know it sounds super complicated, but it's actually this incredible tool that can give us a sneak peek into where the economy might be heading. So let's just dive right in.
I mean, seriously, what if I told you that one single line on a chart has this kind of crazy accurate track record of calling economic downturns before they happen? It's something that economists and investors, well, they watch it like a hawk. And it raises a huge question that we're going to get into right now. And this is the shape that gets everyone talking. It's called an inverted yield curve. See how it's sloping down? Yeah. When the line looks like that, it's widely seen as a flashing red light that a recession could be just around the corner. But why? What's actually going on here? Well, to really get it, we first need to break down what this graph is even showing us. So let's start from square one. At its core, the yield curve is just a graph. It's a snapshot in time that shows you the interest rates, or what we call yields, you'd get for lending money out over different lengths of time, assuming the quality of the loan is the same. So think about it like this. Along the bottom of the graph, you have time. This could be anything from just a few months all the way out to 30 years. And then going up the side, you have the interest rate you'd get for that specific amount of time. You just connect the dots for all those different time periods, and boom, you've got a yield curve. Okay, so we're plotting interest rates. Simple enough. But where do these numbers even come from? What are they made of? Well, let's break down the two main ingredients that make up the curve. All right. First up, we have something called the spot rate. This is exactly what it sounds like. It's the interest rate you get for an investment made on the spot for a specific chunk of time. So the 5-year spot rate, that's just the interest you'd get if you locked up your money today for exactly 5 years. So what sets these rates? It all comes down to the price of bonds. Look at this table here. The price you pay today for a bond that's going to pay you a set amount in the future, well, that price tells you what the interest rate is. The cheaper the bond is today, the higher your return, or spot rate, ends up being. And then there's the other piece of the puzzle, the forward rate. Now, this one's a little more of a head-scratcher. It's an interest rate you agree on today for a loan that won't even start until sometime in the future. It's kind of like agreeing on a price for a hotel room for your vacation next year, but you lock in the rate right now. Let's make this super clear. A 5-year spot rate is pretty straightforward, right? Your investment kicks off today, year 0, and it wraps up in 5 years. It's one clean shot, one interest rate for the whole period. Now, the forward rate, that's a different beast. You agree on the rate right now at year 0, but the actual loan, it doesn't even kick off until, say, year 5. And then it runs for its own term, maybe finishing up at year 7. So this would be a 2-year loan that starts 5 years from now. These forward rates are basically the market's collective best guess about where interest rates are headed. Okay, so now that we've got the building blocks down, let's get to the million-dollar question. Why does this curve bend the way it does? Why isn't it just a flat line? Well, economists have 3 main theories to explain it. Here are the big 3: the expectations theory, the liquidity preference theory, and the market segmentation theory. Each one gives us a different angle on why the curve looks the way it does. Let's dig into each one. First up is the expectations theory, and honestly, this one just kind of makes sense. It basically says the shape of the curve is nothing more than what investors think is going to happen with interest rates. So if everyone thinks rates are going to rise, why would they lock up their money for 30 years at today's lower rate? They wouldn't. They'd pile into short-term bonds. But if they expect rates to fall, they'll rush to lock in today's higher long-term rates. All that buying pressure pushes long-term yields down, and that's how you can get an inverted curve. Okay, next is the liquidity preference theory, and this one really boils down to a single word: risk. As the quote says, the longer a bond's term, the more its price swings around when interest rates change. And this isn't just some abstract idea. You can actually see it play out in the math. So check this out. Let's say interest rates tick up by just 1%. The price of a 10-year bond would drop by about 9%. That's a pretty hefty hit. But now watch what happens when we look even further into the future. For a 20-year bond, that very same 1% rise in rates causes the bond's price to absolutely plummet by 17%. And that just perfectly shows the point. The longer you're lending your money, the more risk you're taking on. And this brings us to the key takeaway here. Because investors know there's more risk in tying up their money for a long, long time, they demand to be paid extra for it. That extra payment comes in the form of a higher yield. This risk premium is what naturally tends to push the curve upwards, which helps explain why a normal curve usually slopes up.
And last but not least, we've got the market segmentation theory. This one suggests that maybe we're looking at this all wrong. Instead of one big single market for bonds, it's more like a bunch of different little markets all side by side. You've got banks who need short-term stuff, and then you have pension funds who are planning for decades from now and need long-term bonds. Each group has its own supply and demand, and the final curve is just a combination of all these separate forces.
All right, so we've got all these theories floating around. That's great. But what does it actually mean for us? How do we use this thing to, read the economic tea leaves and figure out what might be coming next?
Well, when you boil it all down, there are really two main shapes you gotta know. On the left, that upward sloping line is the normal curve. That's the healthy one. It signals that people expect the economy to grow. But the one on the right, the inverted curve, that's the one that makes headlines. Seriously, an inverted yield curve has shown up before every single US recession for the past 50 years. It's a sign that investors think the central bank is going to have to slash rates in the future to fight off a slowdown.
So really, here's the simplest way to think about it. A normal, upward sloping curve is the shape of confidence. It's the market saying, yeah, we feel pretty good about the future. But an inverted curve, that is the shape of fear. That's the market bracing for impact.
So at the end of the day, the yield curve is so much more than just a line on a graph. It's a snapshot of the collective hopes and fears of millions of people all voting with their money. It's a reflection of our shared belief about where we're all headed. Which really leaves us with one big question, right? What is that collective belief telling us about our future today?